what I'm going to do today, what I would prefer to do is to talk for about 10 minutes, because we've only got 20 minutes. So I'm going to talk for about 10 minutes and then do questions and answers, which most of you have questions that are much more interesting to you than my thoughts. We've just finished my strategic investment conference. We had 50 speakers: Kissinger, David Rubenstein, Sir Richard Sharef, Deputy Commander of NATO, George Friedman, so many hedge fund managers, so many famous speakers, David Rosenberg, Danielle DiMartino was here, Tom Honig, former Kansas City Fed chair, Felix Zuloff. So I'm going to try to channel that 40 hours of content in the next few minutes. Bottom line, there wasn't really one person that didn't believe what I've been saying for over a year, which is that the Federal Reserve has already made their monetary policy mistake, and now they got to live with it. And so now they're going to be forced to raise rates into we had a negative quarter this last quarter. I think it's 50-50. We have a negative quarter this quarter, which will make it an official recession. But they're still going to have to raise rates. And they're going to have to raise rates into what will likely be a third and fourth quarter recession, because they're going to have to raise rates. If they do not raise, this is kind of the consensus. Rather dark one, I will admit. And about half the people believe that Jerome Powell is going to, more than half, believe that Jerome Powell will blink. And that he will, at some point, not so much when the stock market drops, but when the credit market begins to panic, that he will stop raising rates and stop quantitative tightening. There's a smaller contingent, including me, that I believe, and maybe this is hope as opposed to reality, I believe that he has to keep raising rates until he drives a stake in the heart of inflation. I can look out here and see that there's a few people in the room that lived through the 70s and the inflation of the 70s. It was not a good time for the stock market, for the bond market, for anything. And if they ease up and they don't drive a stake into the heart of inflation, it will be worse. Inflation will pick up again, and then somebody's going to have to come in and do a Volcker. And I lived through the 82, 81, 80. I was in business, actual, buying and selling stuff. I would literally go to the bank, borrow money, buy a train car load of paper, paying 18% interest. I mean, like a real train car. 40,000 pounds of paper. And the price of paper was going up so fast, and they couldn't make enough of it so that I could get printing jobs and could charge enough to make money at 18% interest rates. That's just insane. But it made me money. We don't want to go back to that time period again. We don't need that. And my personal belief is that Jerome Powell does not want to be Arthur Burns. He doesn't want to be, he wants to be part of the Volcker legend, not part of the Arthur Burns legend. So I think we're in for a rougher, deeper recession than most people are currently pricing into the markets. That means earnings are not going to be what anybody thinks they are now. That means since earnings aren't there, price to earnings ratios are going to come down. Stocks are coming down. I actually am not sure that long-term interest rates are going to go up that much. You start putting a country knowingly, willingly into a recession, long-term rates generally go down. We will get an inverted yield curve. It will be deeper, and if they don't raise rates, if they back off. Now, my second personal belief, and I will be writing this in a letter in about 2 or 3 weeks. I was critical of the Fed in 2018 for doing what I called a 2-variable experiment. If you're in science and you have 2 variables in your experiment, you don't know which one is the cause and which is the effect. So you try to do a 1-variable experiment. And so they were raising rates in 2018, and they were taking down the balance sheet. I think they should raise rates and leave the balance sheet exactly where it is, except as the mortgages roll off, and they can sell the mortgages, buy treasuries. Six years from now, when it's all hitting the fan, when we have what I call the Great Reset, one of the solutions, and I recognize this is heresy, it's unthinkable, it should not even be considered as possible, but we're going to have to consider it anyway, is that the Federal Reserve is going to have to monetize the federal debt. We're going to have to create a value-added tax in the United States to balance the budget, and we're going to have to monetize the debt. That will not be fun, and it will only be possible because we will have a crisis of epic proportions, and people will do things during a crisis that they normally wouldn't do. And that's the only way to get out of that crisis, because we just built up too much debt. We're still running, the Biden administration is patting themselves on the back because the deficit's only $1.5 trillion. Now, that's because we're not doing $6 trillion worth of stimulus money, but nonetheless, 1.5 trillion compounds, and I've laid it out. I do this about every 2 years. Sometime this summer, we'll do it again. We'll go back and use the latest Congressional Budget Office projections, and we'll show that by 2030, 2031, total U.S. debt will be $30 trillion. If interest rates are sitting in the 3 to 4% range, 2 to 3% range, at 50 trillion, that means we got $1 trillion of interest in addition to all the other expenses. We just simply, literally cannot do that. That's what has to go on the balance sheet of the Fed. By the way, same thing in Europe. This is already what Japan has done. So, we're going to become Japan. The good news is that technology is going to be so powerful that it can overcome the inertia that debt would normally produce, so that the economy can still grow. There'll still be plenty of opportunity. The world is going to get better. We don't have to buy gold and dried food and guns and move to the country. Life will be okay. We'll still have families. There'll still be good restaurants. They'll still be making great Chardonnays. They'll just be more expensive. So with that, do we have a way for people to ask a question? Is there a mic? or they just have to stand up? Okay, if you've got a question, stand up. Yes, sir.
Is that going to be right?
Well, okay, they don't have to monetize the entire national debt. They have to monetize some of it. And they don't have to do it all at once. We could just say $1 trillion a year. Okay. And that will be pushing money into the system. We'll get asset inflation. Nobody really cares if their stocks or their houses or prices of stuff goes up. It'll be somewhat inflationary, but not. Remember, it's quantitative easing. Where we got the inflation this time was two ways. We got it from the stimulus money. We actually did what Ben Bernanke talked about, was doing helicopter money. We sent stimulus money to people. Here's your $1,400 check. Here's your child tax things. Here's your $300. My kids were just going, wow, look at, I've got 8 kids. And they were just really excited because these checks were coming into the mail and they weren't from daddy. And in fact, they were more, the government was a lot nicer to my kids than dad has been. So it's not going to blow the world up. Now, if they started trying to do like $5 trillion a year, yeah, that'd be a problem. But they won't do that. But if you stop running deficits and you use the value-added tax to be your float, because we can't cut spending because you can't cut entitlements. Nobody's going to. I mean, you can tinker on the edges with Social Security. I get, I think, close to $44,000 a year in Social Security now. I shouldn't be getting Social Security. I mean, I know I'm due it, and by the way, I do take the money, so I don't feel guilty about it. But we need to means test Social Security. We need to raise the age when people can get it. I mean, but so we can reduce a couple $100 billion of spending that way. But we still are going to have. I mean, there's only so much you can raise taxes on the rich. We're pretty much there. We're going to have a value-added tax. That's the only way to get around it. Like I said, technology is advancing really fast, and the technology itself is going to be deflationary. We're all going to live a lot longer. We're going to have way cooler toys. It's going to be a marvelous age, and technology is deflationary. Kathy Wood's right. Yes, sir. He asked me if I think the government will introduce a digital currency, and the answer is no, I do not. We already have a digital currency. It's called this. I mean, how many of you use cash, really? I've got some cash in my pocket. I suppose U.S. dollars will work here in Canada, but I probably will not bring them out. We will go to more and more. I mean, if we have a digital dollar, okay, which would not, that wouldn't surprise me. I don't think it'll be a crypto dollar. Having a digital dollar is no different than my credit card. Will it give them more control over our lives? Yes. Am I concerned about having a digital dollar? Yes, I am. I mean, it's a lot harder to hide. And by the way, I don't hide anything. I'm in several regulated businesses. I don't get to hide. So, I mean, I've got 2 different accountants and lawyers that do make sure that I don't get to hide anything. But I don't want government having what they have in China, which is being able to drill down and see exactly everything I do. Yes, sir, you asked the question, so come forward. I'm sorry. Yeah. The question was there a consensus on when Powell blinks? There were several of us who said 3,000 on the S&P, if that's the point. But I don't think it's the stock market that will make him blink. I think it will be the credit markets. When the credit markets start to show froth and bubble, at some point they may have to step in. That's what happened the last time. So that's when they had to start buying corporates. Now, I don't know where they get the legislative authority from the Federal Reserve Act to do that, but they did it anyway. I'm sure if some lawyer squints at the Federal Reserve Act hard enough, they'll figure out how to be able to do anything they want to do. But I don't think it's going to be the stock market this time. I think they're going to let the stock market take care of its own issues. By the way, stock market will come back. I mean, that's what it does, but it might take a few years. Okay. My personal opinion is, if you're in index funds, you probably should think about not being in an index fund. Friends don't let friends buy index funds. You do not buy and hold. Okay, index funds are for trading purposes only. You know the joke about trading sardines? Index funds are trading sardines. They're not eating sardines. Yes, ma'am. Come this way. That's a very good question. What are the top 3 things I would do to hedge? Number 1, I would buy, because all of you guys are worth more than, most of you are worth more than $1 million, so you qualify as accredited investors. I would be buying private credit funds. There are, if your investment advisor can't find you a private credit fund, get another investment advisor. Okay, call mine, my partner Steve. You just go to my letter. I mean, there's dozens of private credit funds out there paying 6, 7, 8%, some a little bit more, that are just plain vanilla. There's one that does construction loans on apartments, and they go in and they take ownership of the property, and then they loan the money to the developer. And when the developer ends up developing the property and gets the final financing, then they give the property back to the developer and they get their money back. And they pay, it's like 8%. And they do that because if there's a problem, the biggest problem with construction loans is if there's a problem, how do you get the asset back? You don't want to have to have a lawsuit and get into court and spend a year and a half to get it. No, they just say, we already own this property, we're just going to take it over and we'll finish it ourselves, thank you very much. There's others that do cell towers. There's others. I mean, there's so many ways. Some of them do loans against farmer royalties. I mean, there's so many ways that you can do private credit. And typically, these are smaller funds in the $50, $75, $100 million range, $200 million range. They're too small. $200 million is too small for the big boys to play with. So that's where we're at. Third one is, and I'm going to be doing this, we're 90% sure that we're going to launch a oil and gas fund, and we're just going to drill. We're going to get guys in Texas, Oklahoma, who drill. They've been doing it for 100 years, and some of them with their families. I want to own the oil and gas. I don't want to own your Pioneers or your Exxons. I don't want to own the energy stock market. I want to own the actual oil and gas. I think energy is going to be a play for 4 or 5 years. This is not, I've never done this before. I grew up in the oil patch, boom, bust, boom, bust, boom, bust. You know, I think we're in boom, 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 boom. The ESG movement is a religion, and it's giving us a fabulous opportunity. And I'm blinking here. It's now telling me I have to quit. So thank you very, very much, and I'll let the next person come up.